Okay, welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're talking about maximizing technical analysis with options trading. This is actually a really fun topic for me because it combines my life's work as a market strategist. I spent the first 7 years of my career in the FX markets. I spent a lot of time looking at charts, learning about technical analysis. Pretty much everything you could possibly think of under the sun in terms of technical analysis, I've probably come across either myself or talking to other clients. So what this really does is it helps you combine my understanding of technical analysis and our expertise in options trading and showing you how to combine the two so that you can really maximize your profits and, more importantly, deploy your capital as efficiently as possible with options trading based on the work that you do with technical analysis. So today, what I want to do is I want to show you the power of options when utilized correctly. That's going to allow you to maximize the work that you do on technical analysis. And provide some perspective as to what are the best ways to efficiently deploy your capital when you're trading options. And the reason for this is because as analysts, we spend so much time looking at charts. I certainly spent a lot of years spending lots of time figuring out how to set up my charts the way that I wanted. But at the end of the day, you don't make your money from the charts. You make your money from trades. So it's really important that we understand how we're actually deploying our capital on our trades and are we doing it efficiently. And one of the best things about options is that it really allows us to help manage our trades. It helps us manage our emotions because options have limited risk so that no matter what happens, even if the charts that we anticipate does not work out the way we expect it to, we have limited risk. And that's really the power of options. So today what I'm going to do is I'm going to break down some major forms of technical analysis. I want to provide some tips on how to keep technical analysis simple because I've been down that rabbit hole where you have so many indicators on your chart, you actually don't know what you're looking at anymore. And I want to show you some ways on how to find signals while cutting out the noise. Now, we have a lot to cover here today. There are so many disciplines of technical analysis. I can't possibly cover them all. However, I want to go over broad categories of them and show you which option strategies are ideal for each one of these categories. And then at the end, we'll go through a few charting examples to show you some real life stocks and ETFs that I think have some setups based on the charts, and I want to show you how you can leverage options and options play to analyze those charts and figure out what is the correct option strategy to trade. So let's go ahead and get started here. Just a little bit of housekeeping for those of you that are brand new. If you've never seen OptionsPlay before, welcome. You can sign up for a 30-day free trial for this platform that I'm going to show here today at OptionsPlay.com. Membership is only $50 a month or $500 a year. And as part of that, you're going to get weekly options education webinars just like this, including all the recordings. So after we finish today, I will send out the recording of this video as well as the slides. So for those of you that want to follow along, you can download the slides afterwards while you watch the recording, and you can use the links into our previously recorded webinars. I'm going to reference some of them in our webinar today. So the link for that is in the slides that we'll send you today. You'll also get daily trade ideas that we send out and email to you every single day at 6 a.m. These are stock ideas with an options play along with them. So for those of you that are starting out with options, that are looking for ideas, this is a great way to test the waters. And lastly, if we talk about any option strategy that you don't recognize or you're not familiar with, I highly recommend you to take a look at the Options Industry Council. It is a great free resource that's available to everyone to learn more about options trading. So with that, let's go ahead and get started. Like I said, I have a lot to cover today. I'm going to try to go as slowly as possible, but I do have quite a bit to cover. So if you feel that we're going too fast, please make sure you take a look at that recording afterwards. So today, what I want to start off by is talking about what is the value of technical analysis. I want to talk about what I get out of technical analysis so that it helps frame everything that we're going to talk about here today and why it's so powerful, regardless of what market you trade, whether you trade equities or any other market. Technical analysis is an extremely flexible form of analysis that you can apply across the board. Then what I'm going to do is I'm going to cover 3 of the major strategies that you would utilize with technical analysis. So 3 option strategies that you would deploy. I'm going to talk about them fairly briefly, but I will talk about what they are, how they're constructed, and best practices. But if you want to learn more, I highly recommend you to take a look at either a previously recorded webinar on those strategies or take a look at the Options Industry Council to learn more about these 3 strategies that we'll talk about here today. Now, like I said, there's many different forms of technical analysis. I can't possibly even begin to touch the tip of the iceberg, but the 3 main categories that I will go over is chart analysis and patterns. This is the simplest form of technical analysis that you typically start with, which is simply price action analysis, looking at the price, taking a look at that, and from that gaining a directional view. Next, I want to look at chart overlays. These are indicators that overlay the price chart, such as moving averages and Bollinger Bands. And lastly, what I want to do is chart indicators. These are the indicators that go below the chart. So for those of you that like to use momentum indicators like MACD, Stochastics, RSI, these are the types of indicators these are what we consider a chart indicator. So these are the 3 primary forms of technical analysis that I want to go over with you, and I want to break down each one and show you why different forms of option strategies are suitable for different forms of technical analysis. And lastly, what I want to end up with is talking a little bit about how you can use different forms of technical analysis in conjunction with each other to find high probability signals and also at the same time help you cut out the noise. How do you actually take all the signals and all the indicators out there and only find the quality signals? That's what I want to go over with you. And lastly, what we'll do is we'll analyze some of these in OptionsPlay. We'll look at some live symbols with some setups that I have looked at, and I want to show you why different option strategies are suitable for different setups. So with that, let's go ahead and get started. I want to start off by talking about the value of technical analysis. So I've spent almost 13 years working with technical analysis, building out tools for technical analysis, using it in my trading on a daily basis. So I want to talk a little bit about what I get out of it. Now, before I do that, I just want to do a quick poll. I want to get a sense for how many users currently utilize technical analysis with your options trading. So please just answer the poll on your screen, whether you currently utilize technical analysis or you do not. Okay, so with almost 2/3 of you voted, looks like a predominant, more than 80% of you say that you use technical analysis. 10% of you say you use other forms of analysis. Great. You know, if you have other forms of analysis, I recommend that you continue doing that. But what I want to do is I want to show you what I get out of technical analysis and hopefully enlighten you to take a look at technical analysis, at least as a form of timing, perhaps. So for those of you that are more fundamental based or maybe statistical based, you might find technical analysis is very useful for helping you time your trades. So let's go ahead and see. Looks like with 85% of you use technical analysis, 10% of you say use other forms of analysis, and 6% of you say I'm not sure. So the predominant audience here are technical traders, which is great. For those of you that are not sure or you're using other forms of analysis, hopefully this will enlighten you to take a look at technical analysis as well. So number 1, technical analysis allows you to forecast price based on the past history. So it's looking at what's happened in the past, and it's believing that history may not repeat itself, but it rhymes, and taking a look at those rhythms and seeing how we can project what price will look like in the future. And this allows us to anticipate what is likely going to happen in the future. It's not a crystal ball, it's not guaranteed, but it gives us a sense for what is likely going to happen or a template for what is likely going to happen. And technical analysts believe that markets are efficient, meaning price discounts all information. If you've noticed that whenever there's a news announcement that comes out, that price changes instantaneously, meaning there's no time to process that news and trade on it. Things happen immediately. So we believe that price already reflects all the information that's out there. Markets are not random. So by using technical analysis, we're able to get three very, very important things for trading. And that is direction, magnitude, and timing. So a direction simply means whether we think an asset or a stock is going to go higher or lower. Magnitude means that how far do we think that stock or ETF is going to go higher or lower by. And timing means how long do we think it will take for that move to materialize. And this is really important because when you look at options trading, you have to select an expiration date and a strike price. And how you go about selecting your expiration date, strike price, and even strategy is heavily dependent on your views for your direction, magnitude, and timing. So it's really important to have these three things to help you select the optimal option strategy. So that's why we want to talk about these three things when we're looking at technical analysis. Now, the reason that I look at technical analysis is the fact that I can use this form of analysis and not just apply it to the stocks that I trade or the ETFs I trade, but also other markets. Because when you're trading stocks, you also have to pay attention to other markets like interest rates, commodities, futures, and even the indices. And for other forms of analysis like fundamental analysis, you simply can't apply your discounted cash flow to an index or to a commodity or an interest rate. And that's the limitation that I find with fundamental analysis, is that I can take technical analysis and apply it to thousands of instruments across every single asset class. So the benefit of technical analysis is the fact that it provides me with an objective view on price. It's applicable to all instruments with a price, which generally speaking is relevant to trading equities, because when you're trading equities, you also have to pay attention to what are the sectors are doing, what are the interest rates doing, what are commodities doing. These are all really important. And lastly, in my opinion, the best part about technical analysis is the fact that it's applicable to all time frames. So each one of us that are here on this webinar today have different preferences as to how frequently we trade. A lot of it is dictated based on how much time we have. But for those of you that have time every single day, you tend to be more on the shorter end of the spectrum. You might be looking at 1 hour charts or maybe daily charts. For those of you that are long-term investors, you might be looking at longer-term charts, maybe 1 week charts or 1 month charts. You can apply technical analysis to every single time frame you can chart. And that's the beauty of it, so that it's really adaptable to not only what type of trading you're interested in, but also how frequently you trade. That cannot be said for any other form of analysis. Now, there are limitations to technical analysis. So just like any other form of analysis, no strategy works all the time. Any technical analysis strategy will have times where it works and will have times where it doesn't work. So it's really important to understand your strategy from a fundamental perspective to know when it should work and when it's not supposed to work, so that if you have a string of winning trades or a string of losing trades, you can look back and say, was this the right environment for my strategy? If it wasn't, then you can say, okay, maybe the losses that I had was just some bad luck where the environment wasn't very good, so I'm going to keep sticking to my strategy. And that's a critical piece to being able to survive with trading, is being consistent with your strategy. And this is something I'm going to talk about here today on our webinar. And the last thing is that I tend to get this question a lot as a strategist. People will come up to me and ask, what indicators do I like to use, or what's my strategy? And the answer as a strategist, working with hundreds and thousands of clients over the last decade or so, what I've noticed is that successful traders are not the ones that necessarily have the best strategy or the best indicators, and it's not really about which indicators or which strategy they use. What tends to set successful traders apart from others is the fact of how consistently they are able to apply the same strategy day in and day out. That is really what I tend to see is the key to successful trading. And that's really what I'm hoping to achieve here today, is helping you guys identify a framework so that you can stay consistent and be able to apply it consistently by using the correct option strategy along with that. So with that, what I want to talk a little bit about is not technical analysis, but the trades that you make with that technical analysis. So when you're looking at a chart and you have a directional view, if you're looking at a stock and you feel that it's about to break out and you think it's going to make a big move, what are your choices? What can you do? You have a lot of choices, actually. You can trade the stock itself, you can trade futures, you can trade FX, or you can trade options. And I think there's a clear delineation between these two types of strategies. When you're trading stocks, futures, and FX, you have what's considered symmetrical payoff. Dollar for dollar, if the stock goes higher by $1, you make $1. If it goes down by $1, you lose $1. And this comes with unlimited reward, but also comes with unlimited risk. So this is what you get with symmetrical payoffs. And there are some limitations to this strategy, because when you're trading stocks, futures, or FX, there's no such thing as neutral strategies, meaning if you feel that a stock's not going to move, there's really nothing you could do. You can simply sit on the sidelines and wait till you do think there's going to be a big move. And also, you have limited opportunities to short, because you can't short every stock. There's margin requirements to short that stock. You have to pay margin interest to hold that short. These are all limitations that many times prevent you from shorting something. So which means that you really can only trade in one direction. So you have a lot of limitations for when you're trading these types of markets. And lastly, when you trade stocks, futures, or FX, you have limited controls for your risk to reward. Sure, you can place limit and stop orders on your stocks and other types of strategies. However, stop orders only guarantee you execution but not price, and limit orders guarantee you price but not execution. So it's not really a perfect world in terms of helping you control your risk. You can get close, but it's not exact in terms of defining your risk. Vice versa, on options, we have what's called asymmetrical payoff, which allows you to take a directional view with unlimited reward, but at the same time, on the downside, have limited risk. That is the beauty of options, and you can start combining different options together to really give you the most ideal payoff graph that you're really looking for. And that's what we're going to go over here today, is how do you get the best payoff graph for the technical analysis that you're doing, or more importantly, in other words, what that means is how do you deploy your capital as efficiently as possible for the outlook that you have on the markets. The other benefit for options trading, in my opinion, is the fact that you could trade in any direction, magnitude, and timing. So regardless of what your views are, whether you think the stock's going to go higher or lower, whether you think it's going to go higher by 1% or 10%, or you think the stock's going to stay exactly where it is and not move, there is an option strategy that allows you to profit from that. That cannot be said for any other market. And this is really the market that truly has limited risk, because when you buy a call or a put or a debit spread or even trade a credit spread, your risk is completely limited to the max risk of that trade when you enter that trade. No matter what happens to the market, you cannot lose more than that max risk. And that's a key in helping you manage not only your trade, but also your emotions, because when you lose money in a trade, that's when we tend to lose track of sometimes our initial analysis, and sometimes we do dumb things when we're losing money. So by having truly limited risk strategies, it helps us not only manage our trade, but more importantly, our emotions. And I think that that is a big piece of trading that we don't really talk about a lot in many trading circles, because managing your emotions is difficult, and options provide you with a vehicle that makes it just a little bit easier on managing those emotions. And lastly, you have defined risk reward on each options contract. And again, that speaks to being able to manage your trade once you're in that trade. So the three different strategies that I want to talk about today is three strategies that will help you efficiently deploy your capital regardless of what your views are based on technical analysis. And those three strategies are buy calls and puts, selling vertical credit spreads, and buying vertical debit spreads. Now, the reason these two are on separate sides of the page is because this is really where it starts to come down to what form of technical analysis you do. Now, the strategies on the left, these are strategies that are generally useful when you have a clear sense for direction, but you don't really have a clear sense for magnitude. And this is really one of the things that we're going to go over here today, is what form of technical analysis do you find yourself in where you have a clear sense for direction, but you don't really have a clear sense for how far it can move. And on the other end of the spectrum, you have other forms of technical analysis where you have a clear sense for direction and you have a clear sense for magnitude. So this is really where you feel that, where you have an outlook that the stock's going to move higher and you have a very specific target price. So clear direction and clear sense for magnitude. Versus on this side, You have a clear sense for direction, but you're not really sure what that target price is. You might move a little bit, might move a lot. You don't really have a clear sense. And that's how you delineate between these two strategies. So when you buy a call or a put, that's when you expect a quicker, fast move, but you're not quite sure how far it'll move. And if you expect more of a smaller, neutral directional move, that's when you want to sell a credit spread. So whenever you're looking at a chart, you have to ask yourself, do I have a clear sense for direction, and do I have a clear target price? If you don't, you want to look at these two strategies. And if you do have a clear sense for target price, that's when you want to look at buying a debit spread. This is when you're expecting a modest directional move. So these are the three strategies we're going to go over here today. And just very, very briefly, I want to talk a little bit about the best practices, and then we'll jump over to technical analysis. So when we're buying calls and puts, this is when we're expecting to profit from a large, fast move, a quick, fast move in one direction or another. Best practices for this strategy is you generally want to buy expirations that are at least 1 month or further out, preferably more like 1.5 months or even 2 months out to reduce that time decay of the long call or put. And then you always want to start off by buying a slightly in the money call or put as a starting point. And these are optimized already when you're using OptionsPlay. So for those of you that are using OptionsPlay, we already apply these types of best practices when you type in a symbol and look at calls and puts. For debit spreads, it's really very, very similar to a long call or a put. Because same thing, you want to buy expirations that are greater than 1 month out. You want to start by buying an in-the-money call or a put, a 50 to 60 delta call or a put. The only difference here now is that you're going to sell an out-of-the-money call against that. Roughly about a 15 delta call or a put will reduce the cost basis of that long leg by about 10 to 20%. It'll reduce your overall risk. It'll decrease the time decay, and it will also lower the break-even price. So the stock does not need to have such a large magnitude move before the strategy is profitable. So you'll really see why debit spreads give you that optimal or very efficient deployment of your capital when you have a directional view and you have a clear sense for a target price. And for both of these strategies, the goal here is to simply open them but close them before the expiration date. Both of these strategies are not suitable for you to hold them all the way to expiration. You want to close it out prior to expiration, either at a profit or a loss. The next strategy we want to talk about is selling credit spreads. So again, if these are strategies that are new to you or you're not sure what a credit spread is, we have separate webinars just on these strategies, and I highly recommend you to take a look at those. Selling credit spreads profits from either a small or neutral move. So especially when you think the stock's not going to move very far, or you think the stock's not going to move at all, credit spreads really allow you to take advantage of that you wouldn't be able to do if you were just trading the stock. And when you're selling credit spreads, you generally want to sell short-dated credit spreads. About 3 to 4 weeks out is usually a good starting point for selling credit spreads. You want to start off by selling an at-the-money call or a put, so roughly about a 50 delta call or a put. But selling a 50 delta call or a put by itself has unlimited risk, and you don't want to put yourself in that situation. So one of the ways to cap that risk is to buy an out-of-the-money call or a put against that, usually about a 25 delta call or a put. That will give you that neutral directional view with limited risk. And this strategy is something that you do want to hold until expiration. You want to try to hold that trade to expiration and simply let this credit spread expire worthless. And that means that you keep all the credits, and that is the profit that you receive on the trade. So we're going to go over now a few different forms of technical analysis. We'll show you why one of these strategies fits within each form of technical analysis. And then what we're going to do is we're going to jump over to OptionsPlay and show you some real examples of different forms of technical analysis and why each strategy is useful. So now we get to the fun part. So we're looking at chart analysis. So we're going to start off by simple chart analysis, what I consider support and resistance lines. This is probably the most basic form of price action that you typically learn when you start off with technical analysis. You can think of support and resistance lines as simply floors and ceilings. When it hits a floor, that's where you have an outlook that the stock's not going to go any lower. When it hits the ceiling, that's when you have the outlook that the stock's not going to go any higher. And there are variations of support and resistance lines. I have on this chart a horizontal support and resistance line, but there are many variations of this. You can draw support lines on an angle. This is what we call trend lines. You can put envelopes, you can put channels. There's lots of different variations of this, but they're all based on the same methodology of identifying floors and ceilings. And when it hits a floor, the outlook is that the stock will no longer go any lower and is likely going to bounce higher. And when it hits a ceiling, that's when the stock is unlikely to move higher and is likely going to bounce lower. So there's really a few different ways that you can look at support or resistance lines. In my opinion, you can either see a clear sense for direction and a clear sense for magnitude. So when you've identified previous floors and previous ceilings, that's when you have a clear sense for not only a magnitude, a direction, because when it hits this floor, the outlook is that it's going to rise higher, but you also have a sense for magnitude because you have a prior high to reference. So when this was TLT and it traded between a 116 and 122 range, when it hits that 116 floor, you can, the outlook simply is the fact that it's unlikely going to go lower and it's likely now going to go higher to that 122 target. So when you have a clear sense for direction and you have a clear sense for magnitude or a target price, that's when you want to trade debit spreads, because debit spreads really allow you to efficiently deploy your capital with the least amount of risk and still be able to take advantage of that trade. The other hand, if let's say you don't have a clear sense for prior resistance, you just have a double bottom, or it's hit a floor, but you don't really have a clear sense for how far it'll go. Another way you can trade this is by selling a credit spread, and that will simply profit as long as the stock doesn't fall through the floor. So when it hits the support level, the outlook is that it's going to at least not go any further lower, and if that's your outlook, you can do so by simply selling a credit spread. So when it hits that floor, you can sell a put credit spread, and when it hits that ceiling, you can sell a call credit spread. And as long as it doesn't exceed those levels, you'll be able to profit from this strategy. Next, I want to look at breakouts and breakdowns. So when a stock is trading within a range and it starts to break out of that range, and there's a lot of examples of this in the market today. So when you do have this breakout or breakdown, there's generally two ways to look at this. Generally speaking, when you have a breakout, meaning when the stock breaks to new highs, a 52-week high, or breaks out of a range and starts to print higher highs, this is where you have a clear sense for direction, but you may not have a clear sense for magnitude, because many times at 52-week highs, there are no previous templates for how far it can go. You just have the sense that the stock is breaking out and it's going to go higher, and it's likely going to make that move fairly quickly, but you don't really have a target price on that because there's no price history. So for that, you generally want to buy long calls, because you're going to see a quick, fast move on a breakout, and you want to be able to take advantage of it, and you don't want to necessarily cap the rewards on that breakout. So that's why buying long calls are generally suitable. On the other hand, for breakdowns, you tend to have a clear sense for direction, and you may have a clear sense for magnitude, because when it breaks down, you can look at previous history. You might have to go back a little bit, but you can usually find some price history that gives you a sense for how far is it going to move lower. So because of that, depending on how fast you expect that breakdown to happen, that's when you want to use either a long put or a debit spread, which is just a variation of a long put. So these are the types of strategies that you would use if you've identified either a breakout or a breakdown that will allow you to optimally deploy your capital. Next, I want to look at chart patterns. So chart patterns are usually used to help identify reversals or continuation, and there's lots of different versions of this, but I think double tops, head and shoulders are common ones that most people are familiar with. The less common ones are triangles, flags, pendants. Those are more continuation patterns. Either way, what they do is these chart patterns give you a sense for whether a stock is either going to continue in one direction or another, or reverse in one direction or another. Either way, you get a clear sense for direction. The only difference is depending on the type of pattern, you may have a clear sense for magnitude, other ones you don't. So when you have a double top or a double bottom, which I think is probably one of the more common chart patterns that users are familiar with, this is when you have a clear sense for direction, because when you have a double top, that means the outlook is that the stock is going to move lower. However, you may not always have a clear sense for magnitude. So when you do have a clear sense for, when you feel that the stock has hit a double top or double bottom, and you're expecting a quick, fast move off of that bounce off that support or resistance level, that's when you're more likely to buy long calls or puts. However, the other way that I think is probably better to trade this is that when you hit a double top, what that's really telling me is that the stock is unlikely going to go any higher. And the best way to deploy my capital to take advantage of a stock not moving higher is by selling a credit spread. As long as the stock doesn't move higher, I'm able to collect my credit and profit from that stock. Whether the stock moves lower or not, many times a double top isn't really a good sense for whether it's going to move lower. That's where you might want to look at momentum or other forms of analysis like fundamental analysis that give you a sense for, well, now that it's hit this double top, is it going to reverse or is it just unlikely going to go any higher? And I think the market right now is in that state where it's really rallied quite a bit from the December lows, but that momentum has stalled a little, but there's really no risk or there's no clear risk the markets are going to pull back. So we're kind of in this state where we don't think it's going to go much higher, but we also don't really know that it's going to pull back very far. And that's why selling credit spreads are really a great way to take advantage of this lack of momentum and the fact that markets are near exhaustion, if you will. However, on the other hand, if you are familiar with patterns like head and shoulders, these are patterns that do give you a clear sense for direction and give you a clear sense for magnitude, because head and shoulders, you can use the neckline to measure how far you think that reversal is going to be. And that's really where, in my opinion, the best way to deploy your capital is by buying a debit spread, because that allows you to take that directional view with a small amount of risk, and if you're correct on it, be able to make double your money many times on trading a debit spread. Next, I want to talk about chart overlays. This is any indicator that you would overlay with the actual price chart. So moving averages and Bollinger Bands are prime examples of this. And one thing that I want to point out, and the reason I want to bring this up, is because moving averages is a very, very popular technical indicator. And what I tend to see a lot of users do is when the stock crosses above its moving average, that's typically used to have a bullish view on a stock. And when a stock crosses below the moving average, that's viewed as bearish. So what can you do? Do you buy the stock when it crosses above its moving average, or do you go long the stock when it's above the moving average? And the answer is that's not a great idea. And the reason for this is because when stock crosses its moving average, there's no indication whether that stock is now going to move $1 higher or $10 higher or $100 higher. A moving average doesn't tell you any sense for magnitude. It does give you a clear sense for direction, and that's perfectly valid. But what's not clear is the direction, because as you can see, the stock can move above its moving average and just trade sideways, or it can trade above its moving average and move a significant amount. There's nothing about these two moves that signify any sense for whether the stock's going to rally $1 or $5 in this particular case. So that's why, generally speaking, I recommend that if you're going to trade moving average crossovers, you should sell credit spreads. Because when the stock crosses above its moving average, that's a clear sense for direction, but you have no sense for magnitude. So selling credit spreads is a more optimal way to deploy your capital. You can buy long calls or puts if you do expect a quick, fast move, but that tends to happen more so on the downside. We tend to see that moves or crosses below the moving average tend to be more violent than moves to the upside. So this is really where you have to use your discretion as far as how fast you think the stock's going to move. And a lot of times you can look at the crossover, because if the stock crosses over very quickly, many times you might get a larger move. But if the crossover happens very slowly, you tend to get more of a muted move. So you do have to look at how it crosses that moving average to kind of make that decision. The second I think the most popular overlay is using Bollinger Bands. Bollinger Bands, in this particular case, do give you a clear sense for direction. And because Bollinger Bands have levels, they also give you a clear sense for magnitude. And there's lots of different ways to use Bollinger Bands. You can use them on crossovers. You can use them when they break out above or below the upper or higher bands. There's lots of different ways that you can use them. But because you have a clear sense for direction and magnitude, we tend to find that debit spreads is a better way to deploy your capital if you're using Bollinger Bands for your trading. Lastly, what I want to talk about is probably the indicators that most of you use. if any of you use MACD, RSI, or stochastics, please type them into the chat window. I'm curious as to what are the momentum indicators that people use with their options trading. You know, are you using these MACD, RSI, stochastics, or using even other ones like William Percent R? There's hundreds of these momentum indicators. Please type them into the chat window. I'm curious as to see what users use. But one thing that I want to point out that I see these indicators being misused many times is the fact that leading indicators such as MACD, RSI, and stochastics do not provide magnitude. So here I have a chart of Aurora Cannabis. As you can see, I have stochastics here at the bottom of my screen, and it generates multiple buy and sell signals. Basically, every time it crosses above its upper band and crosses back below, that's a sell signal, and vice versa. When it crosses below the lower band and back into the middle range, that's a buy signal. However, as you can see, whenever this happens, there's no indication to me as to whether this stock is going to now rally or decline by 1%, 10%, or 100%. You can get the signals are all the same. And this is really important to understand, because if you use these types of indicators for trading, and based on the chat window, it looks like a lot of you do, the only strategy that makes sense for any of these momentum indicators is credit spreads. Because when I get this buy signal here, as you can see, there's nothing that tells me whether this stock's going to move 1% like it does here from about $6 to $7 on this buy signal, versus this buy signal where it goes from $5 all the way to $12. There's nothing that these indicators tell me that has any sense for magnitude, and that's really important to understand. With any form of technical analysis, whether you're looking at chart patterns, chart overlays, momentum indicators, do I have a sense for magnitude? If the answer is no, you should not be using buying calls or puts or debit spreads. You should be selling credit spreads. So especially when you identify momentum indicators, what these buy and sell signals and momentum indicators are telling you is simply that momentum is slowed down. Momentum in one direction has slowed down, and it may reverse, but as far as whether it'll reverse 1%, 10%, or 100% there's nothing of that indicator tells you, which is why it's so important to remember. If you use these leading indicators like these momentum indicators, please, when you get that buy or sell signal, don't go buying that stock, don't go buying that call or put, sell a credit spread, because that is the only strategy that you will get that allows you to profit when you have a clear sense for direction, but you don't have a clear sense for magnitude. Lastly, what I want to leave you guys with is a sense for how to actually use these indicators to help find high probability signals and at the same time cut out the noise. So I have a chart here of American Express. There's a lot of things going on with this particular chart, and I have a stochastic indicator here at the bottom. But using this whole chart, out of all the different buy and sell signals, out of all the different moving average crossovers that I get on this chart, there is only a single valid buy or sell signal out of this entire chart. And that's what I have indicated right here. And the reason for that is because what I use, and I'll illustrate in the next slide as to why I say that on this whole slide there's only one single valid buy signal, is the fact that what you want to do if you want to find high probability signals that cut out the noise is you want to combine leading and lagging indicators. So a lagging indicator is something like a moving average that gives you a clear sense for trend, and a leading indicator is a momentum indicator like stochastics. And what you want to do is you want to use them in conjunction with each other. And when you are able to use them in conjunction with each other, that is the only time that you can use momentum indicators and either buy a debit spread or buy a long call or a put. So out of all the buy and sell signals on this chart, most of them, the leading indicator conflicts with the lagging indicator. But this is the only one where you get the buy signal and the stock is above its moving average. All other buy signals happen when the stock is either below the moving average, and the sell signals happen when the stock is above the moving average. So what you're effectively doing is you're trading against the trend. And this is the only signal that you get where where the leading and the lagging indicator are lined up. And as you can see, you do get a very nice magnitude move off of the back of that. And that's why this is the only category that I personally think is worthwhile to buy a debit spread or go long callers or puts if you're going to use momentum indicators. Otherwise, you want to sell credit spreads. So again, just to summarize, you want to trade with a trend. You want to combine a leading with a lagging indicator. A lagging indicator is referring to something like a moving average that provides you with a trend analysis. OptionsPlay provides you with a 1 month and 6 month trend that does this type of analysis for you. And then you want to combine that with a leading indicator so that you're trading with the trend. And the leading indicator is a momentum indicator like RSI, Stochastics, MACD, any of these that provide the trade signal. And you only want to trade the signal that aligns with the trend. When you're able to find that, it doesn't happen very often, but when you do, that's when you get a high probability signal that allows you to buy, call, or trade a debit spread. So for example here, if the stock is trading above its 50-day moving average, that means the trend is bullish. In that particular case, you only want to buy on a bullish stochastic crossover. You don't want to sell that stock on a stochastic overbought sell a crossover. So that's just a quick tidbit on how you can utilize leading and lagging indicators to find higher probability setups. So lastly, I just want to leave you with a few different tips. Number one, the price that you see on your chart is the most important indicator. I see a lot of users that use technical analysis have so many indicators on their chart that they don't even see where the price is. Don't do that. Make sure the first and foremost indicator that you should be looking at is price. All other indicators are there to help provide you with confirmation for your analysis on the underlying price. I generally tend to find as a strategist, you want to follow the KISS method. Keep things simple. The fewer the indicators, the better. Certainly with respect to momentum indicators, you only need one. You do not need multiple momentum indicators. So some of you have answered that you use RSI, MACD, and Stochastics, or several other indicators. Just pick one. Pick one that you're comfortable with. They're all doing the same thing. They're just simply different methodologies to calculate the same thing. There's no need to have multiple momentum indicators. And I can't speak highly enough of understanding your strategy fundamentally. If you're buying a strategy, or if you're using a strategy, make sure you understand why you're using that strategy. So for example, in my particular one here, trade with the trend, I think this is something that most people can understand. You have one lagging indicator that gives you the trend and another one to give you a buy signal, and you want the trend to line up with that buy signal. I think that's one that most people can understand. And then if you just don't have a strong trend, then it won't work when the stock's not trending. So, and this is really the last part that's really important, is stay consistent with the same strategy. If you're going to trade with a trend, do that day in and day out. Don't use this strategy today and another strategy the next day, because you're going to find inconsistent results. And the only way that you're going to be able to stay consistent with the strategy is if you understand it. Because when you have a string of losing trades, you want to go back and evaluate the environment that you were trading in and see if it was ideal for your strategy, and know, is this a strategy? Is this an environment that my strategy should work in, or is it not? Because if it's not, then you can be confident to continue working on that strategy. If it is, then maybe it's time to start tweaking your strategy. But what I tend to find is that if you don't understand your strategy fundamentally, the second you have a string of losses, you start jumping ship and you start looking for other strategies. No matter how good of a strategy you have, there's going to be periods of time where you have a string of losses. And it's really important to understand your strategies in order to be able to stay confident in that strategy. If you're jumping ship every single time you have a string of losses, you're just going to be doing that forever, because there's no strategy that's going to allow you just to make money all the time. So keep that in mind when you're using technical analysis and your options trading, that you're going to come across times where trading is going to be tough, and you have to be able to reevaluate your trades after that string of losses to say, is this a strategy I want to continue with, or do I need to change my strategy? And if you can't answer that question, you're going to find yourself jumping ship all the time, and you're going to get inconsistent results from trading overall. So with that, what I want to do is I want to jump over to OptionsPlay. I don't have a lot of time, but I do want to go over a few different examples and show you, because I think the current market conditions really play into some of the things that I'm going to show you here today. So I have the Qs up. You can look at pretty much any broad-based ETF at this point, and you'll see that the market has had quite a rally since that December 24th low, a rally that really has not had any pullbacks. So we've had this parabolic move that has really started to slow off and taper off, and around some major resistance areas that we saw back in November and December. So the Qs was up against 175 resistance in November. It was against 175 resistance in December. And after having this huge sell-off and coming all the way back, it's now met that resistance level again. So this is what I would consider a double or triple top around 175. And there's two ways to look at this. You can either feel that the markets are overbought and that it's going to correct. But more likely, I think the better way to analyze this, or the smarter way to analyze this, is that I don't think it's going to move much higher, and it'll probably move sideways to maybe slightly lower in the short run before it can pick up any steam to continue moving. Markets don't just move higher like this all the time. And it's had quite a run over the last 2 months. So from my perspective, I think there's few ways to look at this. If you do feel that that is ready for a pullback, so if you do see that, if your outlook is the fact that you think the market's going to pull back a little, I think 162, 163 is probably a reasonable area for it to pull back to. That's also roughly where the 50-day moving average is. So I want to take a look at a few different strategies. I want to look at selling a credit spread, and then I want to look at looking at buying a put or buying a put spread and seeing how that compares. So first I want to look at selling a credit spread, because like I said, I think the best way to analyze a market being overbought is not to go short it, but to simply sell a credit spread, because momentum is telling you that it's likely going to reverse back. But as far as how far it's going to move back, there's nothing the momentum indicators that gives you sense for magnitude. So if what we're comparing here is selling a credit spread to buying a put to buying a debit spread. And what I'm going to do is I'm going to normalize this. So I'm going to say I'm going to risk $2,000 on each trade so that I have the same amount of risk spread across. As you can see, each one of these strategies risks somewhere between $1,800 and $1,900. So I'm comparing apples to apples. And what I want to use is our P&L simulator. And I want to say the Qs are trading at 173 right now. Let's say I think the stock's going to stay exactly where it is and it's not going to move. If I'd sold the credit spread, I make $1,100 profit. So risking $2,000, I'm making $1,100 profit. And this is really the power of options, is that I can have a strategy that makes money if the stock doesn't move anywhere, it doesn't go anywhere. Versus if I bought the put option, I obviously lose $1,600 because the put option is not going to make any money if the stock doesn't move. Same thing with the debit spread. Even though I'm able to trade significantly more contracts, if the stock doesn't move, I'm going to lose money. So clearly, if you think the stock's not going to move any higher, selling that credit spread is by far the most optimal route to go. But I think that realistically, if you do get a pullback, I think you could get a pullback at least to about 166, at the very conservative end of the spectrum. And as you can see here, if you do get a pullback to 166, selling the credit spread still only collects you $1,100 or to about $1,200 in profit out of your $2,000 risk. Not very attractive in this particular case, especially when you compare it to buying a put. You're risking $1,800 to make $1,800, so you have about a one-to-one payoff diagram there. But if you traded the debit spread, you're risking $1,900, roughly the same amount of money. But if it pulls back to even $166, which is only about a $6 move, $7 move, you make $4,000 profit. So again, many times, I'll hear from users, hey, it's bearish and volatility is really high, so I'm going to sell a credit spread. And sure, you'll make some money if you sell a credit spread, but is that the most efficient way to deploy your capital? You expect a small pullback. Is a credit spread the most efficient way to deploy your capital? And as you can see here, if I put the two side by side, I'm risking the same amount of money. If I do get that small pullback to $166, on the debit spread, I'm going to make 4 times the amount of money as I make on the credit spread. this is really why it's really important to not only look at your technical analysis, but also review, how are you deploying your capital as efficiently as possible and making the best investment on, and having the best return on investment for your outlook on the stock. And that's why it's so important to think about magnitude, not just direction. Because a lot of times we think about direction, but we don't put so much time into magnitude, and we don't take that magnitude and factor it into our option strategies. So this really I hope will illustrate to you, how to look at these strategies and view them differently depending on your outlooks on the stock. And as you can see, if you do get a major pullback to 162, there's no comparison here. If you sold the credit spread, still $1,100. The put option now looks more interesting at $3,800 profit, but still the debit spread, $5,600 profit. So for $2,000 risk, I can make $5,600, more than 2 times the return of what I'm risking. And that's really why debit spreads is a very efficient way of deploying our capital. And as you can see, that's why the options play score on the debit spread is very, very high, because it gives you a very good risk to reward if you are correct on this particular trade. So this is just one example. I want to go through maybe at least one, if not 2 more examples before I open this up for Q&A. I know this webinar is a little longer, but we had a lot to go through. There's a lot of material here. I was looking at Goldman Sachs. Financials are looking pretty weak right now, and Goldman Sachs, even though rallying quite a bit and having a pretty good jump on earnings, has really just traded sideways, and this stock really hasn't gone anywhere. So I think this is a pretty ideal candidate for the fact that you kind of have this triple top on Goldman Sachs. There's a lot of pressure on financials right now. So I think the stock is just one of those stocks that's not really going to go anywhere. It's certainly not a very sexy stock right now. There's not a lot of things going on in the financials. So, same thing, looking at bearish strategies, I think a better strategy here is to simply sell that call vertical, selling that credit spread. You can get some decent yield on this particular credit spread. So versus buying the put or the put spread. So again, let's say I want to risk $2,000 on this trade. Here I can sell 4 contracts of the credit spread, buy 2 puts, or buy 3 debit spreads. So this allows me to compare them side by side now. So if Goldman's at 196, let's say it just stays around 195 and doesn't move. Here I make $1,100 profit. Again, out of a $2,000 risk, I'm making $1,100. If the stock doesn't go anywhere, I collect $1,100. If I buy the put, I lose 62%. If I buy the put spread, I lose 50%. So obviously, if the stock doesn't move anywhere, put and put spreads, not useful. Meaning if I don't have a clear sense for magnitude, I'm much better off trading that credit spread. So again, think about magnitude every time you look at your technical analysis or look at your charts. But if, let's say, this does pull back to that pre-gap high of around 180, and I think for anyone that's expecting a move lower or expecting a pullback in the markets, that should probably be a fairly conservative target. As you can see, buying the put spread, $3,000 profit on a $2,000 risk. On the put, $2,000 profit on a $2,000 risk. So this is really allowing you to be very flexible in your trading and allowing you to compare different strategies side by side. And it's so important to look at multiple strategies side by side, because just looking at a chart or looking at an option chain, you can't tell what's the most efficient way to deploy your capital. You have to put the strategies side by side and compare them and get a clear sense for, well, how far do I think the stock's going to move? Because your sense for magnitude will help you determine which strategy will give you the best return. Because if you can even use the slider and see at what point does one strategy start to outperform the other. So you can see exactly around 187, that's when the debit spread starts to outperform the credit spread. And you can move your mouse and see exactly how much profit you'll actually receive from each one of these. So let's go jump over to one last one, Merck's. Merck's made a new 52-week high today. So this is a breakout stock. This is really where you don't have a lot of price history. We don't have a lot of ideas as far as where it's going to go. So this is sometimes better off just buying a call. And as you can see, we couldn't even find a call spread on Merck. So here, let's take a look at, instead of buying the stock or buying a call, if we feel that Merck's, and this stock rallied from about $72 to about $80, which was the prior 52-week high. So it made about an $8 rally over the last, I would say, month or so, from January 25th to about February 25th. So almost exactly 1 month, and moved about $8. So maybe you can project that up another $8 past 80. So maybe you think it'll hit $88 as a target. So as you can see, when you get a quick, fast move, that's when you really want to take advantage of buying a call option. As you can see, a 239% return on a stock that maybe this is a stock that you like from a fundamental perspective, and you see that's made a new 52-week high. How do you take advantage of that big move higher? And I think the key here is not only looking at what is your potential reward, but more importantly, what's your risk? Meaning, what happens if Merck pulls back? The healthcare sector is not particularly strong right now. There is some sense that maybe this might pull back. So if it does pull back to that 72 level, which is where it was just a month ago, as you can see, if you had bought 100 shares of that stock, you're risking almost $1,000. If you bought a call option, which controls the same as 100 shares, meaning you get the same upside as 100 shares, but to the downside, you're risking about a fifth of the value. So instead of risking $1,000, you're only risking $200. That's really the power of options. It allows you to take that directional view, but if you're wrong, limit the amount of risk that you're taking, because that's really the key of this asymmetrical payoff that you really want when you're trading options that you don't get when you're trading stocks. So I know I went through a lot of things here today. That's why we record these webinars and send them to you so that you can review these recordings along with the slides so that you can follow along, especially if there's some things that you want to review. So I went over a lot of things here today, but I hope that I enlightened some of you on the benefits of technical analysis, but more importantly, thinking about magnitude of your technical analysis so that you are optimizing your option strategies and deploying your capital efficiently. So with that, I want to thank everyone for taking the time out this afternoon. I know I went a little long here today, but at this point, what I'll do is I'll open this up for Q&A. If you have any questions, please type them into the chat window or the Q&A window, and I'll answer as many questions as I have time for. And for those of you that are new to OptionsPlay, again, please sign up for a free trial at OptionsPlay.com. You'll get access to quite a few things, including all of our weekly webinar recordings. Can we change the time recommendation from next month to more? Absolutely. You can click on modify and change it to any month that you'd like. So you can change it to a June expiration if you'd like. You absolutely can. You can click on modify and you can change the expiration date, strike price, any of these fields, or you can use our strategy constructor. You can construct any of the strategies that we allow here using OptionsPlay. Laurent and Tom, thank you so much. I really appreciate it. Ida's asking, what is the acronym POP? POP is referring to the probability of profit. So each strategy has a probability based on the break-even price of that strategy, and POP tells you what is the probability of that stock overcoming that break-even price. Michael's asking, what do you think about putting on both a debit and credit spread at the same time? I suppose that if let's say you originally wanted to spend $2,000 on a trade and you now are going to spend $1,000 on a debit and $1,000 on a credit, that I see what you mean. You want to try to capture best of both worlds so that if it stays where it is, you make money on half your trade and lose money on the other half. And if it does make a big move, you make money on both sides. I've never thought of it that way, but now that you put it that way, that makes sense. But I think the key area there is that you want to then split whatever amount of capital you were going to put on a single strategy in half, so that you're only deploying the same amount of capital just now across two different strategies. If that's the case, then I do think that that's an interesting approach to using this. But again, you have to ask yourself, do you have a clear sense for magnitude? If you do, the debit spread is a far better efficient trade. So, in my Q's example, I think that's a prime example, right? Where if you did sell the credit spread, yes, you will make money if the stock moves lower, but a fraction of what you'd make if you bought the debit spread. So if you do feel that the stock's going to move lower, you're much better off allocating your capital to that debit spread. And if you feel that the stock's not going to pull back, you're much better off allocating your capital to that credit spread. Giuseppe saying, how do I feel about Keltner channels? So like I said, support and resistance levels, channels, they all do the same thing. They're just variations of each other. I don't think one indicator is better than the other. So if you like Keltner channels, stick to Keltner channels. Don't use Keltner channels today, moving average envelopes the next day, trend lines the day after. That's when you're going to get inconsistencies. So again, going back to my view as a strategist, it doesn't matter which indicator you use. It really matters as to how consistently you use that same indicator day in and day out. Laurent saying, what volatility is used? So the volatility is always going to be the implied volatility. What methods do you use to choose your daily picks? So the method that I laid out here is very much how we pick our daily plays. So we always want to make sure that we're finding stocks that align with the trend. So we try to find an actual buy signal off of some kind of technical indicator, but we always want to make sure that we're aligned with our trend. We also look at some fundamental factors as well. If we're going to be long, it's a stock that we fundamentally think is sound. If we're short, we generally find that the fundamentals of that stock is not very sound. Alan, thank you so much. Michael saying, but the credit and debit make the play cash neutral. I don't know what cash neutral, sure, but you're still putting up risk. So for me, it doesn't matter how much cash you need to trade it. It's how much money you're risking. Because you still have to put up cash to place that debit spread, and you have to put a margin requirement to sell that credit spread, and that's going to add up to not be cash neutral. Let's see. Whoops. Sorry. Looks like I got a lot of other questions on the other end. So Michael's saying, why not give out the exhibits before the presentation? The reason we don't give out the exhibits prior to the presentation is because we want you to follow along on our screen. We don't want you to have to juggle between our video and then another slide. So that's why we send everything out afterwards. Ron saying, I'm a student, the speed of your speaking makes it difficult to keep up with. I totally understand that. Unfortunately, I had a lot of information to get through today, but Ron, that's why we provide the recordings and we give you the slides so that you can follow along at your own speed. Options trading is something that takes time to learn. It's not something that you're going to be able to learn in just a single 45-minute webinar. However, that's why we provide these recordings. We have all of our recordings available to you on our YouTube channel, and that's included in the links that we send out to you today. So if you want to learn more, I highly recommend you to take a look at our recordings. All of our YouTube channel videos also have the link to the slides underneath them in the description so that you can download those slides and follow along. Ron's asking, what is the difference between green circle and green circle with check mark? So great question. Let's go over to maybe this one. I think that'll help illustrate. I think the question is, what's the difference between a check mark and other scores? The green circle represents the risk to reward of each strategy, and the check mark just simply means that it's a strategy out of the three that has the best risk to reward. So the check mark is just telling you which one has the best risk to reward. David saying, will you ever have real-time quotes? That's actually something we're currently in the process of working on. We have a new data vendor that we're talking to that's likely going to be able to provide our users with real-time quotes. So that is something that we are working on. Michael saying, why is your POW usually 3 to 4 points higher than TOS, Thinkorswim? So there's no one methodology for calculating probability of profit or a probability of expiring worthless. Different methodologies, unfortunately, have different inputs. So, we tend to think that our probability numbers are pretty good because we use a 1,000-point binomial tree to calculate them. So it's a pretty robust method for calculating probability. So I unfortunately can't speak to the difference because I also don't know how Thinkorswim calculates theirs. Greg is asking, does comparing strategies and options play conflict with the idea of sticking with a single strategy? I'm not sure what you mean by that, Greg. So I think what you mean is that if you have a single strategy that you stick to, by all means, stick to that strategy. Just use OptionsPlay in helping you to find your option strategies. So if you don't want to use our charts and you don't want to use our trend indicators or any of our indicators, by all means, stick to your own strategy that you feel comfortable with. Just use OptionsPlay to help you model those outlooks out with using the different option strategies that you can trade. Irina, you're very welcome. Greg, how do you pick which equities to even look at and search for a play? I actually have a whole webinar just on that. So if you go to our YouTube channel, we do have a whole webinar just on finding directional edge. And that is one of the ones that I think you might want to view if you want to look for, if you want some samples as to how to pick equities. That is the crux of how we go about figuring out our daily play. Raymond, thank you so much. I really appreciate it. Michael, same thing. Any other questions? Michael's saying, I use OptionsPlay to check on the recommendations from the other services that I subscribe to. It lets me eliminate some really low probability of profits. Great. Even if, so here's the thing is that many of our subscribers subscribe to other things as well, whether it's newsletters, trading services, your own strategies, whatever that is. You can use them in conjunction with OptionsPlay. You know, we're not saying that this needs to be your one-stop shop, but you will find that many times when you have ideas from other platforms, you can plug them into OptionsPlay and take a look at what the OptionsPlay score looks like. You can look at, you know, particular outlooks and say, can I make a better trade? Many times when you have a newsletter that tells you exactly what trade to make, unless you're looking at it instantly right afterwards, maybe the market has moved a little. And you want to maybe you want to change the strike prices. And that's really where OptionsPlay comes into play, because you can plug in a stock and instantly see the most up-to-date strike prices based on the current price of the stock. So those are some of the different ways that you can utilize OptionsPlay. Can we go beyond April in the trade recommendations? Not sure what you mean by that. You know, you can use whatever expiration that you want all the way up till 2020. We don't limit you in terms of what expiration date you use. What's your win-loss rate this year so far? So 2019 has actually been pretty good so far. We're well into the 70% win rates on our daily plays. 2019 has just been, I mean, December 2018 was a bad year or a bad month, I would say, for OptionsPlay, and I think was a bad month for a lot of users. But 2019 has certainly been off to a very strong start. Michael, thank you so much for saying that OptionsPlay helped me avoid some really bad all or nothing types of recommendations. That's exactly why we use a probability-based approach, is because there's a lot of all or nothing type trades that you can make. And when you look at them as all or nothing, or you look at them as lottery tickets, you're saying, oh, well, maybe I'll take a shot at it. But you basically have a very low chance of making any money, and you're kind of like giving money away. And we really want to help prevent you from making bad trades. And a lot of times, you know, when you set up like this really low, far out of the money put, you know, so for example, I can buy this really far out of the money put. Well, actually, that's not very far out of the money, but maybe if I buy a 167 put, you know, it's really cheap, but as you can see, the OptionsPlay score is really, really low, telling me that there's almost no chance of me making money from these types of strategies. Craig, do you have time to look at the technical analysis for MAC today's daily play? Sure. So as you can see, we were looking at this stock as had a very weak relative strength. 1 month and 6 month trends were bearish. These are all the bearish things that we're looking at. This is an operator of retail malls, a real estate play. So we looked at this from a perspective of real estate is a very weak sector. it's in a particularly industry that's relatively weak within real estate as well. Relative strength was weak. Trends were bearish. These were all the reasons that we're looking at bearish opportunities, and the fact that it broke below a support level very recently, $44. So we have a very tight stop loss on this trade. I think for, on this trade that we would see about a $40 target price at the downside. Certainly didn't move that way today, but we'll see. It's just one day. My expectation is that because of how weak the sector is, the industry, and the relative strength of the stock, that I would expect the stock will trend lower to about $40 over the next few weeks. Greg is saying, what I was saying was what I was trying to ask before is, what is a strategy to stick to with? I think I understand. So the question was, is trading credit spreads not a strategy that you're sticking to? So when I'm talking about strategy, I'm talking about your technical analysis strategy, not your option strategy. So sorry for clarifying if I wasn't clear on that. What I was saying is that how do you determine when do you sell credit spreads? That's what I'm referring to is your strategy. You can certainly sell credit spreads all the time. There's nothing wrong with that. Like I said, if you use momentum indicators like MACD or RSI, you should only be selling credit spreads. So there's nothing wrong with selling credit spreads all the time. It's just your strategy for determining when to sell credit spreads. That's what you need to be sticking to. That's what you need to be consistent with. Zahir, how far out do you go time-wise, and how long do you generally stay before closing? That depends on your strategy. So if you're, like I said, with debit spreads, I think I covered this on the slide about the strategies. So on debit spreads, you always want to close out before expiration. On credit spreads, you want to let it expire worthless. Michael's saying, how do we see the latest daily play trade results? You can go to optionsplay.com/dailyplay. We post every single trade as well as closing trades at optionsplay.com/dailyplay. How far out do you go time? Oh, I think I've already answered that question. Roger's saying, how do you load or change a portfolio? So at this time, we're only making portfolios publicly available. They're not available yet for you to change your own portfolio, but that is something that we are working on. We're working on a technology that allows you to instantly pull in your portfolio from the major brokerage firms so that you don't have to actually load them or change them. It'll just be automatic. So that is something that we are working on. Unfortunately, I don't have enough time to go through another example here. So if you have a question about a specific symbol, please send me an email at info@optionsplay.com. I'm happy to take a look at that. But I'm going over an hour here, so I want to wrap this up. Any other last questions before I end this meeting? Arnold's asking, can you close a spread in one trade like when you open it? Absolutely. I highly recommend that you always close a spread as one trade. You should never close a spread as two separate legs. So if you don't know how to do that, call your broker. Have them show you or walk you through closing a trade at once. You should never close a spread separately. So with that, I want to thank everyone for taking the time out this afternoon. Again, I hope you guys have found this useful. This is really, I found this webinar really fun to do because it's really a topic that I love to talk about, technical analysis and showing you how to deploy your capital as efficiently as possible, because that's really the work that we do as a strategist day in and day out, is trying to find trading opportunities and trying to figure out how to trade those opportunities as efficiently as possible. So hopefully this also enlightens you in helping you to think in that same way, and hopefully this helps improve your trading. So thank you so much for taking the time out this afternoon, and I hope you guys have a great evening, and I'll see you next week.